If you own an investment company that rents out multiple different properties, you'll be interested to know how much salary you, as a director of the company, can take from the company and also get a tax deduction, because we know the tax rate on rental income for a company is 25%. So your salary will obviously be a deductible against your profit, but how big of a salary can you actually take and actually get a tax deduction for? Well, Revenue have given some guidance on this that I want to cover in this video. And this has been handed down over the years through various different legal cases. Firstly, it is important to consider whether your rental company is considered an investment company. So, generally, a rental company that holds more than one property will be regarded as an investment company. Also, a rental company that holds one property but also holds other classes of investments in more than nominal amounts, for example, government bonds or stocks or shares, will be also regarded as an investment company. And Revenue as well will not seek to distinguish between the making of and the holding of investments. However, the nature of the operations of the property rental company should be such that its main business is the making of investments, and the principal part of its income is derived from those investments. So the guidance is fairly straightforward. If you hold more than one investment property, or you hold some other separate investments in the likes of stocks or shares or bonds, then you will be considered an investment company. So, what then is Revenue's view when it comes to directors' remuneration for property rental companies? Their view is that directors' remuneration is an admissible deduction to the extent that it is reasonable, having regard to the services rendered or the duties performed. So that is really just saying you shouldn't be getting a salary over and above the actual work that you're doing. So in practice, Revenue say they will have no objection to payments that do not exceed 10% of gross rents, but where the directors devote a substantial part of their time to the management of the company's properties, and there is not a separate management charge going through the business for the management of those companies, payments that do not exceed 15% of gross rents will not be questioned. So you can increase it to 15% if you're doing all the management of the properties yourself. And then what about a situation where you have a company that has rental income and it also has some other investment income, say interest income, for example? How do you work it in that situation? Their view is where the income of an investment company includes rental income, to which the 15% limit would be applicable. The 15% will only be applied to the rental income, and the 10% limit would be applied to the other income of the company. So let's have a look at an actual real life example just so you can kind of get that clear in your head. So the following example illustrates the proposed treatment of directors' remuneration in respect of an investment company, where the company's income includes rental income and where it is established that the directors devote a substantial part of their time to the management of the company's properties. So this company had gross rents of €200,000 and it had other income gross of €40,000. So total income there of €240,000. So we know based on the rental income, we can take up to 15% of the gross rents because there is no management charge and the directors are doing all the management of the properties themselves. So you can get a tax deduction of €30,000 based on the gross rents. And you can also take 10% of the other income. So €40,000 there by 10%. So in total, you have your 30,000 plus your 4,000. A 34,000 deduction for director's remuneration will be admissible in your corporation tax return for this company. So that is some important revenue guidance that you should be aware of when you are setting up your investment company. You kind of have to plan ahead on how you're going to get your money out of the company as tax efficiently as possible. And this is something to really take into consideration.